Look, I need you to understand something that's happening right now, in real time, that most people are completely missing. While everyone's distracted by headlines and political theater, there's a systematic dismantling of a 50-year control mechanism that's kept gold prices artificially suppressed. And we're watching the final chapter play out. Let me take you back to August 1971. Nixon closes the gold window. The dollar becomes pure fiat overnight. But here's what they don't teach you in economics class. That wasn't the end of gold's role in the monetary system. It was the beginning of something far more sophisticated. A control system so elegant, so deeply embedded in market structure, that most traders don't even realize they're operating inside it. The London Bullion Market Association and the COMEX Futures Exchange became the new gold window. Instead of direct convertibility, they created something more powerful: price discovery through paper contracts. Think about the genius of this for a second. You don't need to confiscate gold. You don't need to make it illegal. You just need to create a market where 100 paper claims exist for every physical ounce, and suddenly you control the price without ever touching the metal. For decades, this worked flawlessly. Central banks could lease gold into the market during price rallies. Commercial banks could short unlimited paper contracts. The Bank for International Settlements could coordinate interventions across time zones. It was beautiful in its complexity. Gold would rally, paper would flood the market, price would collapse. Rinse and repeat. But something broke in 2022, and it's never been fixed. The Russian central bank got cut off from dollar reserves. Overnight, $300 billion frozen, and every central bank governor on earth had the same thought simultaneously: if it can happen to Russia, it can happen to us. The dollar isn't just a reserve currency anymore. It's a weapon, and weapons can be turned on you. Watch what happened next. China's central bank started buying gold every single month. Not occasionally, every month. The People's Bank of China added 225 tons in 2023 alone. But here's the part that should terrify anyone short this market. They're not buying paper gold. They're taking physical delivery. Bars are leaving London vaults and disappearing into Beijing. Gone. Permanently. Poland's central bank bought 130 tons. Singapore is adding to reserves. India's accumulating. Turkey's buying despite economic crisis. The Czech Republic just announced new purchases. These aren't investment decisions. This is monetary survival instinct kicking in across the developing world. And the West? The Federal Reserve hasn't bought an ounce. The European Central Bank is static. The Bank of England is sitting on the same reserves they had in 2008. They're still playing the old game, assuming the paper market will hold, assuming the control mechanisms still work. They don't. Let me show you what's happening in the physical market right now. The Shanghai Gold Exchange, where actual metal changes hands, is trading at a premium to London and New York. That premium hit $70 per ounce in October. $70. That's not a premium. That's a scream from the physical market saying, we don't trust your paper prices anymore. The U.S. Mint can't keep up with Gold Eagle demand. Premiums on physical coins are running 8 to 12% over spot. Dealers are quoting 4-week delivery times. This isn't 2008 where premiums spiked during a crisis and then normalized. This is the new baseline. The physical market has permanently decoupled from paper pricing. And here's where it gets really interesting. The COMEX warehouse stocks. Total registered gold, the stuff actually available for delivery, is sitting around 8 million ounces. Sounds like a lot until you realize that open interest in futures contracts represents claims on over 50 million ounces. That's a 6-to-1 leverage ratio. 1/6 of contract holders could stand for delivery and the entire system would seize up. Now, historically, only 2 to 3% of contracts go to delivery. The system was designed around that assumption. Financial players roll contracts forward, take cash settlement, never want the physical metal. But what happens when that assumption breaks? What happens when even 10% want delivery? We got a preview in March 2020. The futures market went into backwardation. Near-term contracts traded higher than deferred contracts. That's not supposed to happen with gold. Gold has storage costs. Deferred contracts should always trade higher. But for a brief moment, the market was screaming, we need metal now, and we don't care about the premium. The COMEX changed the rules overnight. They allowed delivery of 100-ounce bars instead of 400-ounce bars. They expanded eligible vault locations. They did everything possible to prevent a delivery default. And it worked, that time. But the pressure's building again. And this time it's not a liquidity crisis that will pass. This is structural. This is central banks in the East saying, "We're done with your paper games," while central banks in the West pretend everything's fine. Let me tell you about a guy named John. Retired engineer, 68 years old, sitting on $400,000 in a traditional IRA. All stocks and bonds. He watched 2022 happen, saw his portfolio drop 18%, and started asking questions. Why does his retirement security depend on the Federal Reserve's ability to manage inflation? Why is he forced to trust that the dollar will hold value for the next 20 years? He's not alone. There's an entire generation of retirees and near retirees who lived through 2008, watched the money printing after COVID, and are now seeing inflation eat their purchasing power in real time. They're starting to understand that diversification isn't just stocks versus bonds anymore. It's paper assets versus hard assets. Quick aside here, because this is relevant if you're in John's situation. If you're sitting on $100,000 or more in retirement accounts, there's a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide on exactly how it works. It's in the description below. Covers the rollover process, IRS rules, storage requirements, all of it. Worth looking at if you're thinking about this kind of protection. No pressure, just information if it's relevant to your situation. Anyway, back to what's happening in the macro picture, because this is where it gets wild. The BRICS nations just announced they're developing a gold-backed trade settlement system. Not a gold-backed currency, a settlement system, meaning countries can trade with each other, settle the balance in gold, and bypass the dollar entirely. Russia and China are already doing this for energy trades. Iran's selling oil to China for yuan. China's converting yuan to gold through Shanghai. The petrodollar system is being dismantled in real time. And the West's response? Silence. Or worse, dismissal. Gold is a barbarous relic. The dollar's dominance is secure. This is just noise. Meanwhile, the rest of the world is building alternative infrastructure. Saudi Arabia just joined the BRICS Development Bank. The Saudis, the country that's been the cornerstone of the petrodollar system since 1974. They're not abandoning the dollar tomorrow, but they're building optionality. They're creating alternatives. And every alternative they build weakens the dollar's monopoly on global trade. Here's what people don't understand about monetary systems. They don't collapse overnight. They erode. Slowly at first, then suddenly. The British pound was the global reserve currency in 1920. By 1950, it was done. 30 years of gradual decline, then collapse. The dollar's been the reserve currency since 1944. We're 80 years in, and the cracks are showing. Look at what happened in 1980. Gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 today. But here's what's different now. In 1980, Paul Volcker could raise interest rates to 20% and kill the gold rally. He could make the dollar so attractive that capital flooded back into treasuries. Can Jerome Powell do that today? With $34 trillion in federal debt? With deficit spending at $2 trillion per year? Raising rates to even 10% would make the debt service costs larger than the defense budget. The Fed is trapped. They can't raise rates high enough to defend the dollar without bankrupting the government, and the market knows it. That's why gold's been grinding higher despite rate hikes. That's why it hit new all-time highs in 2024 while the Fed was still in tightening mode. The old playbook doesn't work anymore. And here's the really scary part for anyone betting against gold. The suppression mechanism is breaking down at the exact moment that demand is exploding. It's not just central banks. It's not just retirees protecting purchasing power. It's institutional money starting to wake up. Ray Dalio's been talking about gold for years. Stanley Druckenmiller's long gold. Paul Tudor Jones is long gold. These aren't gold bugs. These are macro traders who've made billions reading market structure and positioning. And they're all saying the same thing. The dollar's dominance is ending, and gold is the only asset with no counterparty risk. Think about what that means. Every other asset is someone else's liability. Stocks are claims on corporate earnings. Bonds are promises to pay. Even real estate depends on property rights being enforced. But gold? Gold is just gold. It's been money for 5,000 years because it's the only asset that exists outside the financial system. And right now, the financial system is more fragile than any time since 2008. Bank balance sheets are loaded with underwater bonds. Commercial real estate is imploding. Regional banks are quietly insolvent. The Fed's backstop facilities are the only thing preventing another March 2023 situation, and everyone knows it. So what happens when the next crisis hits? When the Fed has to choose between defending the dollar and bailing out the banking system? They'll choose the banks. They always choose the banks. And when they do, when they fire up the money printer again, gold is going to move in a way that makes 2020 look tame. Let me paint you a picture of what that looks like. It's 2025. A major European bank fails. Derivatives exposure spreads contagion across the Atlantic. The Fed announces unlimited dollar swap lines. The ECB restarts QE. The Bank of Japan intervenes in currency markets. And gold gaps up $200 in a single session. But here's the difference from 2020. This time, the paper market breaks. The COMEX can't deliver. Futures go into permanent backwardation. The spread between paper and physical blows out to $500 per ounce, and suddenly everyone realizes that the price they've been watching on their screens isn't real. It's just a number on a computer, backed by promises that can't be kept. The physical market reprices overnight, not to $3,000, not to $5,000, to whatever price is necessary to pull metal out of private hands. Because that's what happens when paper claims exceed physical supply by 100 to 1. The paper burns, and the physical finds its true value. And the people who saw this coming? The central banks that spent the last 3 years accumulating? The retirees who moved a portion of their wealth into physical metal? They're protected. Not because they got lucky. Because they understood that the game was ending. You know what's fascinating? The mainstream financial media is still not covering this story. CNBC talks about gold when it makes a new high, then forgets about it. Bloomberg focuses on the Fed's next 25 basis point move. The Wall Street Journal writes about stock valuations, but the biggest monetary shift since 1971 is happening in plain sight, and it's barely mentioned. Why? Because acknowledging it means acknowledging that the entire post-1971 monetary system is unwinding. It means admitting that the dollar's reserve status isn't permanent. It means confronting the reality that 50 years of debt accumulation has consequences. And that's not a comfortable conversation for institutions that depend on the current system continuing. But the market doesn't care about comfort. The market cares about supply and demand. And right now, demand for physical gold is exceeding supply at current prices. That's not speculation. That's observable fact. The premiums, the delivery delays, the central bank buying, the COMEX inventory drawdowns, it's all pointing in the same direction. Here's what I think happens next. The paper price continues grinding higher, making new all-time highs every few months. The physical premium widens. More central banks announce purchases. The BRICS settlement system goes live. And at some point, probably during the next financial crisis, the paper market breaks completely. When that happens, there won't be a smooth transition. There won't be an orderly repricing. It'll be chaos. Futures markets halted, exchanges implementing position limits, governments potentially restricting gold exports. And the people who waited, who thought they could buy physical at paper prices whenever they wanted, will discover that the metal isn't available at any price. This isn't fear-mongering. This is pattern recognition. Every fiat currency in history has eventually failed. The dollar's lasted longer than most because it had the backing of the world's largest economy and military. But that advantage is eroding. The economy's financialized and fragile. The military's overstretched. And the rest of the world is building alternatives. Gold isn't going up because of inflation. Inflation's just a symptom. Gold's going up because the monetary system that's existed since 1971 is reaching its endgame. And when monetary systems change, gold is the bridge. It's the asset that survives the transition. It's what central banks hold when they don't trust each other's currencies. And right now, central banks don't trust each other. Russia doesn't trust the dollar. China doesn't trust the dollar. Saudi Arabia's hedging. India's accumulating. Even European central banks are quietly reassessing their reserve compositions. The trust that held the system together is breaking down. So when I say the final days of suppression are here, I'm not being dramatic. I'm reading the market structure. The paper-to-physical ratio can't be sustained. The COMEX inventory can't handle a surge in delivery demand. The London vaults are being drained by Eastern central banks, and the Western central banks that could intervene to suppress prices are politically and economically constrained from doing so. The control mechanism is breaking, not because of some conspiracy, because the underlying conditions that made it possible no longer exist. You can't suppress the price of an asset when the largest buyers in the world are taking physical delivery and removing it from the market permanently. You can't maintain paper leverage when trust in paper claims is evaporating. This is the end game. Not tomorrow, not next week, but soon. And when it happens, when the paper market finally breaks and physical gold reprices to reflect actual scarcity, the people who positioned ahead of time will be protected. The people who waited will be scrambling. The question isn't whether this happens. The question is whether you're positioned before it does. Because once the break occurs, once the physical premium blows out and the paper market loses credibility, there's no going back. The monetary system will have changed, and gold will have reasserted its 5,000-year role as the ultimate store of value. The suppression is ending. The evidence is everywhere. The only question is whether you're paying attention.